Good afternoon or good morning, depending on the time zone that you might be tuning in from today. Welcome back to another session at Fintech Nexus. I'm your host and moderator today, Todd Anderson, Chief Content Officer. Before we go ahead and turn it over to our esteemed panelists for some introductions, just a couple of quick announcements for the audience. First, thank you, obviously, for coming, if you're watching live or if you're going to be watching on video. We appreciate your attention. If you are watching live, we do encourage you to participate. So if at any point you want to ask a question, just go ahead and click the Q&A function in your Zoom window and throw those questions in there. We'll begin to pose those questions to our panelists throughout the discussion. If you have a technical issue, a general question not related to the discussion, we ask that you use the chat. So if you use the Q&A for the questions for our panelists, the chat otherwise, and that way we can keep an eye out for both of those. Also, special thanks to Mike and the team at Fintech OS for their support and partnership. Obviously, without partners like them, we can't do sessions like this or the large-scale events that we put together as well. And also special thanks to our speakers, Mike, Dan, Jamal. You obviously don't see Jamal on the screen there. Robert couldn't make it, so Jamal has stepped in his place, and we thank him for that. And without further ado, when I get to my fellow panelists here, first, just quick plug, May 10th and 11th, New York City, Fintech Nexus USA. Check out fintechnexus.com for more details. You can get tickets. Prices will go up in a few weeks, so make sure you get your tickets today. Fintechnexus.com. You can still buy tickets, still submit to speak, and sponsor. Now you've heard from me. I will pass it around to my panelists for some introductions. I'll go top left of my screen. So Mike, I'll give you the honors first. Tell the audience a little bit about you and a little bit about your firm.
Sure. Thank you, Todd. And welcome everybody to the webinar today. Thanks for joining. My cues have been in the tech space for almost 30 years, which both when I write it and say it makes me feel a little bit old now. But, it's been a good run. I've also been in and around kind of what we now call low code for most of that time back in the 90s. I actually worked for a company called James Martin and Company. And they created a case tool that generated COBOL code from models. It's basically an early form of low code platform. I also spent 6 years at OutSystems, kind of right as that low code term was being coined by Forrester. And as Todd mentioned, I'm now with a company called Fintech OS. We provide a Fintech Enablement platform that's all about applying kind of this low code concept to vertical markets. So that means including a whole host of financial capabilities and solutions out of the box, but then they can be quickly adapted to any customer's needs using no code and low code tooling. Our goal is to help simplify financial technology so that banks and credit unions can actually act like fintechs, right? So empowering them to quickly launch new products and services, react to the changes happening out there in our world, all while juggling kind of their existing IT investments. So excited to be on the panel today and to work with the other guys on here.
Thanks, Mike. Dan, tell us a little bit about you and your role at KeyBank.
Thanks, Todd, and thanks everyone for your time today. Looking forward to this panel. I'm responsible for embedded banking at KeyBank. What that specifically is the enablement of our services out to fintech platforms to power different financial applications. I've been with the bank for a year. My background includes, was part of the founding team for a fintech startup previously, and then also I've been in payments several decades, both running major bank product lines as well as some time doing processing. Thank you.
And Jamal, tell us a little bit about you and your role at Alliant.
So Jamal James, I've been the manager of product implementation at the credit union for almost 3 years. Essentially, we're responsible for the launch of fintech partnerships, the review and sustainable growth, and essentially growth within the credit union of the partnerships. Prior to that, I was on the product management side in the residential and commercial space. So it's come a bit full circle for me at Alliant. I've been here for 7 years.
All right. Thanks for those introductions. I want to get the session started today. I think a lot of what we're going to be talking about is going to really be focused on kind of how banks and fintechs interact and work together. And I think it's an interesting time, obviously, that we're having this conversation with all that's going on in the market the last few weeks. And so I just wanted to get us started and to get some thoughts from the folks on the panel. Dan, I'll start with you, and Mike and Jamal, I'd love your input as well. Are bank fintech partnerships in a good place today? And kind of how is that evolution of the two working together going as we sit here today with some of this, kind of current turmoil? Where would you say we sit today?
Yeah, I definitely think there's been some success stories. There's definitely a lot more awareness in the market of its importance, but fundamentally, I would say we've got a long ways to go, right? There's still a lot of friction in the process. Like if you're a fintech or software platform, you're fundamentally creating the user experience you want may be overly complicated, where there's many partners potentially that you're integrating with. There's a lot of friction in the technology interoperability back into the banking system. There's a lot of working capital that gets tied up. So if you're a platform trying to move fast, this is still fundamentally hard. And I would say on the flip side, if you're a bank, it's, again, you can cite success stories, you can cite wins, but when you think about your banking services living inside of software, there's also a lot of friction there in terms of managing risk, understanding, bringing your organization along. So as much as I'm excited about how far we come, there's still way too much friction in this.
I happen to be at an event this week in lovely Las Vegas where lots of banks, credit unions, and fintechs are all together. So I can share just a few observations from here because it's obviously very timely. I think first, there's a ton of new fintechs, right? Just rewards, crypto, cards, blockchain, you name it, right? I mean, everything under the sun. I think that's a positive sign, right? There's a lot of energy on the fintech side. As I've been speaking to the banks and credit unions, I think, what's obvious is that there's really a spectrum when it comes to readiness. There are those that just scratching the surface, having initial conversations. There are those more like, Jamal, that they have a whole team dedicated to thinking about how to bring in fintech to address some of the challenges, some of the friction that Dan mentioned there as well. So it was interesting just to see that, the spectrum. It wasn't really, I thought it was interesting, third point, there wasn't really a direct correlation between the size of the institution and kind of that readiness, which I thought was interesting. Often I would think, well, the bigger, more IT enabled might be more kind of driven. But what was interesting is I think, the drive is more about the people kind of leading the charge within the organization. It's kind of about attitude, ambition, and that didn't seem to be as correlated to size. So I thought that was interesting. I think overall, I think it's positive. I would agree with Dan, right? There's a ways to go and the potential for friction. I think the general consensus is that banks, we can't do this alone. So there needs to be some way to partner and work, in other ways. So, a few reflections.
Yeah, I would agree. I think also a big part of it is finding the right fit. So, not every fintech would be the best fit for the financial institution and vice versa. So while I agree there is a lot of optimism and positive opportunity, I think that's one thing that will continue to grow and we'll continue to see is finding somebody who's the best fit and not just necessarily going after a great opportunity because it might be the next shiny thing.
As a reminder to our audience, if you have questions, please input them in the Q&A box, and we'll go ahead and pose those questions to our panelists. So, Mike, I'd love to dig a little bit deeper with you. What are some of the key points and key areas of focus that you hear from banks who are ultimately looking to partner? Maybe their size of the bank plays into that. and what they can accomplish on their own, but what are some of the pain points that ultimately they're looking to solve when they're trying to find a partner like Fintech OS or others that are out there?
Yeah. So it really depends who I'm speaking with, of course, right? Often we're speaking to a line of business, so they're paying me. How do we drive revenue? How do we get to new markets? So often, the nature of the conversation is around that, right? It's how can your technology help me get to a new market? What does that mean? My existing portfolio, have you done this before? Or who have you done it with, right? So it's more about kind of credibility. But then if I'm speaking to a CTO, a CIO, right, then it becomes a lot more, I think, around some of the points Dan made, right, which are and Jamal as well, right? Are you in the same cloud as we are? What coding languages are in use? Can my team use your technology? A frequent concern that we hear is around vendor lock-in, right? That's a topic that comes up quite frequently. People are concerned about kind of getting into that situation. So openness of platform, right, tends to be something people are looking for more on the technology side, right? To make sure they don't recreate some of the pain points of the past, right? Where you've got these very siloed implementations. Many of the organizations, right, they're kind of juggling innovation and modernization at the same time. So the IT agenda is we've got to modernize the systems, right? Our core is old. How do we move forward? But at the same time, the business is like, we need to better compete, right? How do we drive innovation? So that's kind of an interesting conundrum, right? So they're looking for technology that can help them kind of deliver on both of those agendas because they are quite different. Overall, I'd say, what's refreshing, I think, from the conversations we're having is that it feels banks a bit, being very pragmatic about it, kind of realistic, not just, going in there demanding certain types of outcomes, but kind of taking it more as a partnership, right? Kind of having a bit more of an open conversation, understanding what's possible, what a reasonable time looks like, right? That hasn't always been the case in the past, right? So I think that to me is refreshing. I think banks are understanding the challenge to a degree and trying to mitigate that in various ways.
And I'll just add in there, Mike,
Yep.
I think as somebody who's, kind of sits in that bank seat and thinks about the challenges we have, I agree. We've got a lot of, we've got a lot of infrastructure and capabilities that have evolved over time.
Yeah.
Right. So it's more like the streets of an old European city than it is anything planned out. So when you look at that and you start to think, okay, we are serving new markets, we're serving verticals, we're needing to distribute our products in a very digital, technology-centered, specialized way. It's definitely a lot of rebundling and packaging and orchestration across all those products can get to be very complicated. So we are always looking for ways to just sort of simplify what it means for this complex infrastructure to be consumed by clients in any form. Because our old payment rails aren't going anywhere, but the experiences on top of it are constantly evolving.
Yeah, that makes sense.
Jamal, I'd love to get your input in terms of the seat that you sit in. Obviously, when you work with a partner, you find a partner, you're not going to go from, hey, we've just found each other to 100 miles an hour. There's kind of a journey within that journey. How does some of that implementation work, and ultimately how can the fintech and the bank begin to build trust with one another as they kind of go on this longer term journey together?
Definitely. I think one of the biggest things starting off, especially with building trust, is transparency, both from the fintech and the bank, understanding that, we may not have this now, but we can work to build towards this and vice versa, instead of trying to, make up for it and realizing when you make it to the finish line that, one or the other may not have had everything that was previously anticipated. But a lot of it is, understanding, how does this mutually beneficial for both parties? So for the bank, or in our case, a credit union, it may allow us to get into a new product that we previously didn't originate, and allow us to get more comfortable with that. So with that, there's a lot of work within compliance, legal, making sure that the proper information is being captured and things like that. But I think a key within that, that kind of guides the whole thing, in my opinion, is running off of an MVP. So instead of trying to do everything at once, you do the minimum viable product. What do we need in order to get this going? Because if you try to do everything at once, there's a good chance you might miss deadlines or miss the overall scope and picture of what are we trying to achieve. So within that, as you move through a lot of the technology integration, which unfortunately may be some of the slowdown within a launch, you look towards, in our case, what fields are needed, what do we need to report back on, what do we need to originate these loans, or what do we need to be able to, in our case, because we're a credit union, what do we need to be able to create this membership and work from there to determine what is needed and structure to build out from there.
I actually have a question, Jamal, for you, just based on some of the conversations I've been having this week as well, where I've been hearing, things like, oh, we're 1 year into an MVP, which for me, I'm like, an MVP in 1 year, right? That seems like a long time. What's your feeling for like the amount of time that needs to go by before you show something of value, right? Like, is it 1 year feels like a long time? I feel like we've created a service offering that basically delivers some level of value in 12 weeks. Because my experience, from consulting days is that change is kind of a momentum game. You have to kind of get that ball moving and show some results. How much time do you have, right? When do people start getting like antsy and saying, is this really going to work, or is this just going to be another failed attempt? What's that time frame look like, would you say?
For us, because we're taking in loans, it needs to be a fairly quick turnaround. So we launch, like I said, in the most simplistic state, making sure that we're getting the captured information. But within a couple of weeks of launch, the expectation is we are onboarding these loans, making these borrowers members, and all the back end processes are being done. So for us, we launch at MVP, but quickly after, whatever things are needed to make this full scale, or even automation is a big thing, and making it easier for our other internal teams, such as accounting and finance and some of our other teams. That's more the build out, data warehouse. That's some of the additional build out that we do that may not be as clean cut at launch, but the expectation is we will soon after be able to do this, or else, to your point, it doesn't make as much sense. How long does a MVP can't go on for forever?
We had while you guys were chatting there, we had a question come in from the audience that I think is a good time to bring it up, from Matthew Riley. So thank you, Matthew. He says friction was mentioned. What are the top 1 to 3 friction points that cause disengagement or consumer abandonment in fintech bank partnerships, especially those that you all believe can be addressed? They give proof of employment and or income. But I think the first point is really the one to hit on here is, is there 1 to 3 friction points that cause a disengagement when banks and fintechs, tie up and work together?
Yeah, and I'll start with that one because I think it was referring back to kind of one of my opening points. I think, and I'll answer 2 ways. There's sort of the friction between fintech and bank relationships and structuring good partnerships. And then I think the answer just talks a little bit about the user experience of a consumer. When you look at fintech and bank partnerships, I mean, I do think there is a fundamental need to recognize the strength of the other institution or the other side of the partnership. And I think Jamal made the point of like a win-win, right? And I think sometimes it gets framed up as high tech versus dinosaur, regulated versus innovative, but that's the wrong narrative. Like there's fundamental competencies of creating specialized user experience and software that platforms are very good at, that ultimately are the workflows associated with financial services that make them great, right? Those are the best experiences. And when you look at what a financial institution does around secure money movement, compliance with regulation, efficiency of capital, the ability, that comes with a bit of like scale and control. So you kind of got the specialized group and the scale and control organization, and they need to understand each other. And in essentially out of the gate, like the ability to just jointly educate, don't assume everyone has the same orientation in it. When that doesn't happen, it's when relationships fall apart, right? It's if there is no, so I think getting those ground rules established up front is critical. When you get to other ones are typically technology integrations, like what it means to code, test, change, evolve, huge friction point. And that's where, honestly, I know us as an institution, we're investing a lot in because it does need to be better, right? You got to support a high rate of change, which isn't really what banks were built for. And then I'd say the third friction point is generally risk. I mean, at the end of the day, it's in just understanding who's taking it and how to decide how to the trade-offs that are involved in owning that risk would be the last one. When it comes to the consumer portion of the question, I do think that there is the most successful platforms I've seen ultimately stage the engagement with the client, where there's some level, you're not asking for everything at once. You're doing something small, you're earning trust, and you're building that relationship over time. And that, I think if people do that, consumers are more willing to provide the information necessary for financial services, like know your customer, those types of things. If you're not asking for it all right up front and you've built that trust by delivering value from your platform.
It's balance, right? So you get like the click here, download this paper, and you start the process, right? And then suddenly ask you for one piece of information and two pieces, so that there's the point where you suddenly feel, oh, I've been deceived. So that's an interesting kind of like balancing out, right? How do you make sure it's, it doesn't come across as kind of deceptive? I think I would echo what Jamal said around transparency, right? The counter to that, right, in terms of friction points would be a lack of transparency. I think Dad made this point too, right? You have to have an open discussion, right? Be realistic about what you actually have, what you don't have, right? Otherwise, it's like any relationship. If there isn't trust, right, it's not gonna go very well. So I think these aren't really new problems, right? I think that's the same for any kind of vendor partner type relationship that has been around for decades, right? It's not just about the technology. There's lots involved, right, in maintaining a healthy relationship, and there needs to be something for both sides, right? Otherwise, it doesn't make sense.
I think another thing that's key too is looking at, what are we trying to achieve? What is the job to be done here? Because a lot of times for us, it's looking at efficiency. What's the best and most efficient way to get this done, or to launch this, or to build it out? Because sometimes both parties can get caught in the circle of, this is the way we've always done things, which may be true, but ask yourself, why are we doing it this way? Because sometimes if you ask yourself why, you may realize that it doesn't make as much sense, or may not make as much sense now. Maybe when we started, it made a lot of sense because we were limited, but now, there's a lot of opportunity for innovation and efficiency. So a lot of times that can reduce some of the friction because you find more efficient and more innovative ways to get the same job done that you once did.
Yeah, it's like the 5 whys, right? It's annoying when you're a parent, but and when it comes to like understanding why you're doing things, it's pretty important to answer those questions.
In hearing you guys talk for the last couple of minutes, a question came to mind, which is, does some of the friction come up with, or a different way to ask it is, do both parties always have the same view on value? And does value necessarily mean value to the organization, our mission, and kind of who we're looking to serve? Or does value mean the revenue number went up 25%? Is that always clear? And how important is it to balance the revenue value and the value of what the organization either stands for or looks to serve, and the communities that they're ultimately serving? Dan, it looks like you want to jump in to at least start.
Yeah, no, it's a great call out, and it's a great question. I think if you looked at the last 4 or 5 years and kind of the huge surge in fintech investing, kind of before it cooled off, revenue was definitely the storyline, right? It was the fintechs themselves driving their ARR and therefore driving their valuations. Banks through fintech partnership, getting access to fee income in forms of distribution that they couldn't before. And it was revenue with, and in software speak, it was customer acquisition cost. How can I get somebody onto my platform as low cost and as simple as possible? But if you look at what that value, and that's, I would argue we almost obsess to it to a fault, because there's another side of the equation, which is long-term value, right? It's not just how quick you get them in, it's how, which is one moment in time when you sell, it's how long do you sustain these relationships, and how valuable are you to the financial institution, or how valuable is it to that technology, fintech? And that value comes down to, other things, right? It's, do we have the ability to service and grow these relationships? How is our net promoter scores in this? And then when you throw in the recent news with Silicon Valley Bank, you also have to think fundamentally, are we a good operator, right? Is this a scale business? So I think the key to structuring good partnerships and assessing value is not to just think about the revenue. It drives valuation, but revenue isn't just a sale. Revenue is a product of selling, servicing, operating well, scaling, and a bank and fintech need to be able to do those things well together to ultimately deliver value to the end consumer.
Yeah, and I think coming from the vendor side, right, those discussions need to be had up front, right? You need to be clear on why are we entering into this relationship, right? What outcomes are we looking to have? And I mean, ultimately, you could boil it all down to revenue, cost, risk, right? But it's usually much more nuanced. You may be driving operational efficiency, right? Trying to reduce costs through automation, but it may not just be a cost factor, right? It might be that actually employee satisfaction, right? Because they're using old systems and they don't like it, right? They've just come out of college, now they're using a green screen, right? They're not going to stick around very long, right? So that employee satisfaction could be an attribute, right? That's actually, the value is there, right? It's employee churn, right? Because you're losing people. Dan mentioned NPS, right? If you're creating new experiences, putting them out to market, right? It could be about driving value through, revenue streams. But, if you have a terrible onboarding experience, right? Getting out quickly isn't going to be that useful if your experience is bad. So things like NPS, customer satisfaction, longer term value then become really important. I was listening to it's been a few years ago, but it was head of a large bank talking about, their digital journeys were state of the art, they thought, right? But when they actually measured customer drop off, it was actually quite high, right, above industry averages. So they went through this process of realigning their organization. All of their metrics were driven by its journeys, right? So making sure they optimized. Everyone was thinking about, the same kind of metrics and aligning around that. So I think that's key, is understanding what value means, right, in terms of the metrics, making sure it's measurable, right? You've aligned on what the metrics are, but you can't measure it, that's not really that helpful. And then how do you report that up to show progress, right, along the journey as well? So there's a lot I think there's a lot of thinking up front that needs to be done to be aligned, right, on both sides. And again, that's transparency, having those conversations, but also technology can help, right? You can actually measure these things, right, in a meaningful way and report that up so that people actually understand what progress is being made, right?
Jamal, I'm curious to if you had any comments on the value one, feel free to jump in. But also, you had mentioned earlier about making sure it's a two-way street when working with partners. But what happens when problems arise? Obviously, not everything's going to go swimmingly every day. But how do you address some of those problems and ultimately work through them to avoid a potential breakup, and what do you learn along the way as you're dealing with problems that arise when doing some of these implementations?
Yeah, so unfortunately, like you said, problems do arise. Even if they are minor, there's going to be issues. I think the biggest thing is take the time to understand what fundamentally is the issue. Is it that we're not collecting the necessary data? Is it that our systems aren't speaking together? Is it, a return issue as far as making sure the returns make sense? Or even if it's, a compliance or legal issue, you have to understand what the problem fundamentally is. And then from there, both parties have to be willing to solve it. If one party just says, hey, take it or leave it, then unfortunately it makes it very difficult to solve any problem, because if it's something especially regulatory that you need, you can't just say, oh well, we'll do it anyway, and we'll just omit that portion. So I think both parties have to come to the table and be willing to work to figure out how we can get around the issue. Maybe there is something where there's some data that needs to be collected, and maybe there's another way that the bank or credit union can work to get that information so that it can move forward. Compliance, other things, how can we work to obtain or clean this up so that it can launch? So I think that's the biggest thing. And sometimes you'll come to a point where you realize that, one or the other may not be able to have what is needed to launch. And at that point, I don't necessarily think, especially because of the time and effort you put into it, that it will be a breakup. Maybe it might just be a short pause or a postponement until one or the other is able to build up the infrastructure so that they can pick up where they left off. But oftentimes, if you've made it down the road of this far, making sure that there's a good fit, product-wise, value-wise, things like that, sometimes it's a small issue that, you just need to work around in order to bring everything to a whole.
Yeah, I think, a lot of the conversations we have are because, the relationship a bank has with their incumbent vendor isn't really a partnership, right? They have needs, they're trying to have a conversation. It might take 3 months just to have the conversation, and then the outcome of that might be, well, maybe in 6 months we'll consider that for the roadmap, right? So things aren't moving quickly enough. That's not really a partnership, right? So I think, the opportunity is for fintechs, for organizations to create like a working dynamic that actually addresses the needs of the financial institutions. But there's another side to it too, right? I've certainly been in situations where it's kind of like a big bank against small vendor, right? So you do what we say, right? And that's not really productive either. You need to have kind of equality, like any relationship, right? It needs to kind of have a balance. It goes for our personal lives as well as professional, and that we see things like having a champion inside of the account, right, within the bank makes a big difference, right? Someone who's an advocate for the vendor as well. So otherwise, it becomes a one-sided relationship in the other way, which can also be unproductive, right, and lead to friction. I think things we can do, right, as vendors, right, have a customer success team, right, a team that's focused on the success of the customer. Success could be the value that we've talked about, but on our side, success could be a customer that's willing to be a reference, right, someone that's willing to be in a webinar, right? Those are all measurements that we can think about and gauge whether we're being a good vendor or not. So I think it's about balance. If it's too weighted in either direction, right, that I think that leads to friction, just like any relationship.
As a reminder to the audience, if you have questions, please input them in the Q&A box, and we'll get to those questions as we continue to move through our conversation here. Clearly with what's been going on in the market, risk jumps to the top of the stack. Is there a misnomer, I guess, about the way in which fintechs operate, which is, hey, we're faster, we're innovative, we break things, and does some of those I guess descriptions of fintech, how does that impact in terms of how banks or credit unions might look at fintechs? And is there kind of a misalignment in kind of the perception out there and how a lot of fintechs might operate? So I think maybe Dan and Mike, you want to take that first as a bank fintech angle, and then Jamal, feel free to jump in as well if there's any views that credit unions have on that type of subject as well.
Yeah, I think it's the narrative around it hides the issue. The narrative is like, we're fresh and that's how, and it's really about like two sides of a coin, or like the foundation on which a building is built, right? Like fundamentally, like payments, financial services are going to continue to live inside of software and digital experiences in fintech. Like you could just look across the board at the numbers. I think if you were to buy card acquiring, in 2018, there was a 9 in 10 chance you got it from a processor or a bank. If you do it now, you get more than half the time you're going to get that service from a specialized software platform. Like, it is out there, it's in the world, it's not going back. And that is ultimately because of this ability to specialize the user experience. But a lot of times that the orientation would be, oh, this thing I'm being asked to do, whether it's some, know your customer process or gathering data like social security number or last four, these things are seen as like, oh, fundamentally intrusive to it because they're seen as just overhead. But like if you come back and you go like, why do those exist, right? Like the trade-off on the financial service and the risk side is they exist for really good reasons, right? Like, first one is like, everything's, if your platform, everything's good till you have a major fraud event, right? Like, the one thing financial institutions are used to is people trying to rob them since the beginning of time, right? Like, these things exist to both protect you, protect the business, protect the end consumer, right? Like, fundamentally, like, there's a reason for that. The other one is some of the stuff around bad actors and anti-money laundering, these things that just seem like, watch a Netflix series. Like, there are people that do awful things that fundamentally you need to keep out of this. And there's a responsibility that comes with that. And I would argue that most investors in tech platforms want to see the control environment and the operating environment of their platforms be mature and show these types of risk mitigations because they can take down the value. So I think it's just really more about plotting the fintech on a maturity curve and making sure as a bank you're a partner to them at the beginning stages all the way through them owning more of their operations and scale. And if both people start to see it as, yeah, I want to specialize the user experience and I want to have a solid operating model, then you find this balance that makes it work, right? And you have an understanding of why you have to ask for some things when. It's when you pit risk against innovation and you, in a simple narrative, you lose like what it means to do both well. And businesses, especially fintech, have to do both well.
Yeah, I think that's a great point. I think you need to find, I think Jamal was kind of getting into this a little bit with kind of his role as well. You have to find ways to move forward. You can't just be always risk averse, right? If you don't do anything, change is the constant, right? We know with COVID, right, the organizations that didn't change, a lot of them aren't around anymore. So there's risk adverse, but then there's like people that just don't do anything because it's always perceived as too high a risk, right? And you need to find that balance and enable innovation in a way that's deemed, I guess, safe, right, within the organization. I think controls are a big part of that. I would agree, right? As a vendor, we get, large questionnaires to fill out, right, just to show that the fundamentals are there, right, that we're not just an inherently insecure platform, right? So I think part of it's like the due diligence, right? And I would imagine, Jamal, and your team, there are things you do as you're speaking to fintech vendors, right, to make sure that they pass some bar, right? But the bar can't be so high that you don't get to actually work with anyone, right? So there is a balance. And then it's kind of how do you move forward, right, and manage that risk as part of just kind of your operational rollout as well. So I think it's another balancing act, right? It's kind of like the partnership angle as well. A lot of this is about balancing and making decisions based on transparency, right? Based on data. I think, it's fundamentally about enabling both sides of the coin that Dan described.
Definitely. And I think to an extent too, from both parties, both the fintechs and the financial institutions, you need to look at where the other side is coming from and what they need. So from a financial institution side, we do need to mitigate some of that risk. We do need to make sure that the company is sound, that we're partnering, because at the end of the day, we have some reputational risk as well if something bad were to happen. So the questions and the due diligence that we're doing is not to just be difficult, is to, ensure that this goes through soundly and with the least amount of issues as possible. But from the fintech side, I understand that, there is a big push for growth, innovation, and, with the least amount of friction for the customers that you're serving, maybe asking some additional questions may reduce your pull-through rate for whatever product that you're serving or the service that you're serving. But you have to understand too that if you do omit certain questions or not require certain things, that may limit who may be willing to partner with you because you are unable to provide that information. And at the end of the day, you have to be okay with understanding from our strategy standpoint, we will omit doing these certain things, but understand that we may encounter these obstacles when it comes to partnering, or we may do a little more, but understand that we might lose some people in the funnel, but it will potentially ensure our success down the line when it comes to partnerships.
Yeah, there's an interesting question from Chris there in the Q&A around just kind of, which is a bit of a different angle. Yeah, a bit of a different angle, right?
That. Yep.
Yeah, go ahead, sorry.
No, that's okay. The question that Mike was referencing is, I would love to hear what experience the panel has in fintech partnerships that improve risk management for banks and credit unions. What's the experience and what lessons were learned?
I'll just give one perspective as kind of the, on the vendor side then. Certainly, when we're speaking to banks, one of the things they're looking for are ways to reduce risk, right? By using technology, by taking advantage of, services that fintechs provide, like liveness detection, right? Being able to scan documents. So anything that helps mitigate risk, right? During some digital journey, for example, is stuff that we're asked about, like how can we bring that right into our experiences today? So there's definitely a lot of interest in using technology in fintechs to be able to improve risk management, right? Reduce cases of fraud, eliminate the bad actors. I'd love to hear, from Dan as well and Jamal, kind of what they see, what their experiences have been, and any lessons they've learned.
I'd say the lesson learned for me is show, don't tell, right? Even as you're building consensus in your organizations, like it's hard for everyone to imagine a different future. So if you can show what you're talking about, like, hey, this is how this could help us, I think that goes a long way. The other one is like a lot of risk, fundamentally risk management is about having more information and being able to act on it more quickly. And that technology fundamentally enables that, right? It's when technology is positioned as a lot of unknowns that, oh, it's all these people you don't know what they're going to be doing, that it's perceived as risky. But if you can just say, we're doing these things and here's how we see it, and show how you see it and show how you can act on it, then all of a sudden it goes from being something perceived as being high risk. So, oh, this is more information than we have today. This will help us. Definitely. And you have to do all that consensus building at the beginning.
Yeah, definitely. I pretty much just echo what both of you all said as far as, being able to gather the necessary information, but also being able to leverage what the partners bring to the table to become potentially more risk averse through what they're collecting or through their KYC and other practices. So definitely there's opportunity to leverage what in our case, the fintechs have to be able to ensure that we reduce bad actors or any other potential issues down the line.
We talked a little bit about the, when problems arise earlier, but, how do you balance the need to work through some of the partnerships, but also at the same time, try to fail fast enough that you're not spinning your wheels for 3 years and oh, now this isn't the right partner. We've gone through stage 1, stage 2, stage 3. Now we're breaking up, but we've wasted all this time. There is a balance there. And how do you do that and figure out, okay, there's value here versus, hey, it's time to move on. That's feel for anyone to jump in on that.
Yeah, it's the hardest thing I think I deal with, which is experimentation, right? Where you're because you do have to be pretty buttoned up on what you're putting out in market because of compliance, because of risk. So it's not easy to just experiment on something. I'll agree with what Jamal said. like in general, you have to have an MVP model. You can't make things too big and too complicated. You've got to get out there with small increments that you test and learn from. So start small, right, is one, but with a big vision behind it. The other thing I'd say for just pure like practicality, right, is you don't have, as a financial institution, like you don't have to like do it all, right? Part of it is you can sort of say like, hey, this is what we own within our walls, and we're going to control this part of the customer experience. Client, as long as you're within that guardrail, you're fine. You go specialize for your industry, you go specialize for education, for healthcare, you go experiment with different experiences and applications, but just work within these parameters. And if you can create those kind of frameworks, that's where it kind of gives you is another way to get the best of both, where you're able to experiment with new things, see what takes, but not break the boundaries of always having to come back to heavy bank processes around compliance.
When I talked about kind of the importance of understanding the desired outcomes right up front, right? This isn't something you should be discussing 3-6 months into the relationship. You should be clear on what success looks like early on, so it's less of a painful, like, it's time to cut bait, right? Right? It should be transparent to both parties that, look, we thought we were going to achieve X, right? These are the metrics we agreed on. This is the reporting, right? We've been transparent throughout the process. We just haven't gotten there, right? It might not have been the right idea, right? The market opportunity wasn't what was thought to be there, right? So you don't want to just kind of beat that dead horse. Doesn't make sense. So I think clarity up front around what success looks like. MVPs, right? Going out with the friends and family version, right? Just testing out things in a safe way, right? Dan's point as well, right? You can't just throw garbage out there, right? There's reputational risk, there's potentially compliance issues, right? So you have to balance that. But I think just being clear on the outcomes and the timeframes, and then having that open conversation to say, okay, well, we didn't achieve X because of these reasons. We believe we can achieve X with, a bit more time, rather than just kind of like moving forward with with just kind of these false beliefs that magically things are going to happen, right? That doesn't make sense. So I think it's about measuring, it's about using data, it's about making decisions based on what you know, right? Not just what you hope. Hope is not a strategy, I think. Bosses points years back.
Yeah, I think also, Mike, to your point, the value that the partnership is going to create needs to kind of be your North Star, because if you start veering from that, you may, achieve a lot of things, but you have to ask yourself, did it achieve the value that we had hoped to bring? Because or else you're just, unfortunately, you're just doing a lot of cool things, but what is it laddering up to? So I think that needs to be a focus, but also from our perspective, it's about creating efficiency and repeatable processes. So we use this to launch this partnership or to implement this service. How can we repeat that? Because you can, bend over backwards and create something and, do it within a timeline and realize that you're going to have to bend over backwards and go through the same hurdles all over again. Why not, if you're going to scale this, why not find the most efficient way to do it and a repeatable process? So we know, okay, we bring in this partner, we need this, this, and this, and create those procedures. So, even when you're potentially entertaining a new partnership, do they have these things? If not, you understand early, we may have hurdles to overcome down the line, but you have the understanding, you can set an expectation early on because you learn from your past experience what may or may not work or what's needed, instead of unfortunately making it down the line. And like you said, 2 or 3 years later, you realize that we veered off a little bit and you didn't have anything as a guide to keep you on track.
I think the other thing I'll add in is, like, it's never like the happy path best case scenario and that catches people. It's always the exception. It's always the outlier components. And I think making sure that you're putting some time into anticipating those and kind of designing around the edges is, I think, critical to success as well. Because I think one of the things in fintech applications, most that we put up, like, you always have to balance, you always have to reconcile. It's always got to be exact, right? You can't sort of leave the edges unattended. So that when you're going through these, to Jamal's point, like setting expectations at the beginning and getting into these projects, like you definitely need to be thorough.
If anyone has any final questions, we're coming up on our last few minutes here. Please put them in the Q&A box. I did want to kind of begin to look forward a little bit as we come to a close here. I guess two questions, which is is the fintech bank partnership model. Do you see anything that points to that collaboration being in trouble long term? If not, then how do we ensure that we stay on this path of collaboration? Because I think there's been a lot of value gained from the two working together versus the two just competing and saying we're going to take you over or we're going to crush you down. How do we ensure that era of collaboration stays, and that we're still talking about this subject years from now? Maybe I'll go Jamal, Dan, and Mike to wrap us up.
Yeah, so I think I don't think we're in trouble by any means. I think, like I had mentioned before, it's all about a proper match. What do we hope to get out of this? So for some of our partnerships, like I said, it allows us to venture into other asset types that we previously don't have the means to originate ourselves or aren't as familiar with. So that's part of the value that we are to get out of it. So that's kind of when we look to approach a fintech when it comes to product. That's kind of what we look at, and where can we benefit from this, and also how can the fintech benefit from that. So I think with that mindset of what value and what can we achieve out of this, I think that can create healthy relationships. I think sometimes when you get into the realm of doing things just to try them or experimenting with options that you're not as familiar with as an institution, it's hard to set expectations when you're not familiar with what the potential outcomes can be. So I think that's where it can get into potentially troublesome territory when it comes to implementation or even understanding what is the ideal outcome.
Yeah, I mean, we will be talking about this well into the future. Like, ultimately, technology is everywhere, and it continues to be more specialized, and it is how financial services will continue to be delivered. And you could look across every category, every metric, and it's undeniable, right? I think the future winners are ultimately the ones that make interoperability easier, right? And the analogy I would use is like electricity, right? Like if you just plug it in and it works, right? And you don't question it. And if I'm a fintech, I'm the lamp in this analogy, the financial system needs to be the plug, right? I can just plug it in and I've lit up the room, so to speak. But we're not at that stage as an industry, but we will get there. And I think that's going to come down to education sessions like this, but it also means fundamentally like rethinking a technology forward view of risk management, a technology forward view of integration, and a clear understanding of what it means to enable a platform to service people in a very specialized way.
Yeah, I don't think it's a question of if. I think we're going to continue to move forward, right? I think we're going to continue to have conversations on both sides about how we can create win-win relationships between fintechs and banks. A great point from Dan, right? It needs to become seamless. Like that layer of abstraction needs to kind of get created above to where you aren't even thinking about it. It's just an ecosystem of stuff, right? And you can assemble solutions more easily. It just takes a while for the technology to mature, right? But things like blockchain, right? You can see where that has evolved to a point where it's less about like this just kind of difficult to understand technology. It's just, I need to know who gave me this thing, right? And that becomes easier through technology. So I think technology is a key. We see obviously as a technology vendor, an opportunity for technology to help make this more seamless in the future. So that does create these win-win relationships, right? I think both sides have a huge amount to gain by working together.
I think that's a good place to end. Both sides working together. Mike, Dan, Jamal, thank you for your time and effort. Special thanks again to Fintech OS for their partnership and their support, as well as to our audience for your questions and your participation. As a reminder, our event May 10th and 11th coming up in New York City. Check out fintechnexus.com for more details, and we'll have this replay ready and out on YouTube in no time. Thank you, everyone, again. Enjoy the rest of your day.
Thank you.
You.